receivable over net credit sales times 365. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, ending accounts receivable over net credit sales times 365. Days sales outstanding, ending accounts receivable over net credit sales times 365. Days sales outstanding, 365 over accounts receivable turnover. Days sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory.
Father God, thank you for this beautiful day again, Friday. We bless your name, Lord, for giving us the opportunity to come back here again to continue with our study sessions. Thank you, Lord. We ask you that you forgive our sins. Give us your Holy Spirit. Give us knowledge, understanding, critical thinking. Give us wisdom and intelligence. Give us the capacity to understand difficult ideas and be able to explain them in a simple way for everyone to understand. All the glory belongs to you. We pray in Jesus' name. Amen. We are attacking a new chapter. The chapter we're attacking now is inventories. We're gonna learn a lot about inventory. So let's get started. The company had the following consignment transactions. Let's see if you can hear this. Okay. The company had the following consignment transactions during December year 1. Inventory shipped on consignment to Omega Co., $36,000. Freight paid to Stone, freight paid by the company, $1,800. Inventory received on consignment from Gamma Co., $24,000. And freight paid by Gamma is $1,000. No sales of consignment goods were made through December 31st, year 1. What amount of consigned inventory should be included in the company's December 31st, year 1 balance sheet? This seems simple to me. Inventory shipped by the company is $36,000, and shipping cost is $1,800. Inventory received on consignment by the company is $24,000. Shipping cost by the company who ships the goods to the company is $1,000. So we will only work with the inventory shipped by the company, $36,000 plus the shipping cost, $1,800. That makes it $37,800. And this is correct. All right. So I need an explanation for this anyway. All right. Let me see what explanation I have about that. A consignment arrangement is when one party, the consignor, places goods with another party, the consignee, who then holds them and charges a fee for sale to the third party. The goods remain on the consignor's books as inventory throughout the arrangement because the consignor retains legal ownership up to the point of sale. Any transportation cost, example, freight paid, incurred by the consignor for the goods to be delivered to the consignee are added to the cost of inventory. All right, so Stone Co. is the company, is involved in two consignment relationships. The company shipped inventory to Omega Co. So the company is the consignor or consignor. The inventory shipped on consignment will remain as the company's inventory, including the cost incurred to transfer the goods to Omega. Therefore, the company will report $37,800, which is the cost of inventory plus the shipping cost. Okay. And all right, so that's simple. Let's go to the next one. The company's ending inventory balance was understated by $8,000 in the current year. Which of the following statements is correct according to a periodic inventory system? All right, the company's ending inventory balance was understated by $8,000. So it was understated by $8,000. So there is $8,000 that was not counted in the current year. Which of the following statement is correct according to a periodic inventory system? The cost of goods sold was understated by $8,000. Yes. The cost of goods sold available for sale overstated by $8,000. If you understated $8,000, cost of goods sold of inventory, cost of goods sold will be understated too. The net income was understated by $8,000. Let me go with cost of goods sold. Inventory, cost of goods sold. Let me see. No. The net income was understated by $8,000. What? Okay. Let me see. Okay, so I need explanation. The net income was understated by $8,000. Yeah. And then ending inventory. Okay, I see what's going on. Ending inventory was understated. Okay. by $8,000. This is a great CPA question because it tests whether you understand the inventory equation, not whether you memorize the answer. Step 1, start with the formula. Okay. Under a periodic inventory system, cost of goods sold equals beginning inventory plus purchases minus ending inventory. Write the formula vertically so the whole thing can appear on the screen. Okay, so beginning inventory plus purchases, cost of goods sold equals cost of goods sold available for sale. Cost of goods sold available for sale minus ending inventory equals cost of goods sold. Or combine it into one formula. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. The relationship to memorize: ending inventory goes up, cost of goods sold goes down, net income goes up. Ending inventory, okay. Ending inventory increases, ending inventory increases, cost of goods sold will decrease, net income will increase. Okay. If ending inventory increases, cost of goods sold will decrease, net income will increase. If ending inventory decreases, cost of goods sold will increase, net income will decrease. This is the entire chain tested on the CPA exam. Ending inventory, cost of goods sold, gross profit, net income, retained earnings. Whenever ending inventory changes, simply follow the arrow down the chain to determine the effect on every account. Okay. All right. Ending inventory increases, cost of goods sold decreases, net income increases. Ending inventory decreases, cost of goods sold will increase, net income will decrease. Okay. All right. Ending inventory increases, cost of goods sold will decrease, net income will increase. If ending inventory decreases, cost of goods sold will increase, net income will decrease. Ending inventory decreases, it affects net income. Net income decreases, cost of goods sold increases. Ending inventory increases, net income will increase, cost of goods sold will decrease. Okay. In this question, ending inventory balance was understated by $8,000 in the current year. It will affect net income in the same direction. So net income was understated by $8,000. If ending inventory balance was understated by $8,000, net income will be understated by $8,000. Cost of goods sold will be overstated by $8,000. This is the relationship. Okay. So we understand the relationship here. The company reviewed its LIFO inventory values for proper pricing at year end. The following summarizes two inventory items examined for the lower of cost or market. Lower of cost or lower of market. Original cost, inventory item 1, $210,000. Replacement cost, $250,000. Net realizable value, $240,000. Net realizable value less profit margin, $208,000. Inventory item 2. Original cost, $400,000. Replacement cost, $370,000. Net realizable value, $410,000. Net realizable value less profit margin, $405,000. What amount should the company include in inventory at year end? If it uses the total of the inventory to apply the lower of cost or lower of market. Let me get explanation for this so we can move faster. We have a lot of work to do. A lot of work. We have a lot of work to do, my friend. All right, this is a classic lower of cost or market LCM question under US GAAP. The old rule used for LIFO and retail inventory, the key is to find market first. Step 1, remember the 3 rules. Ceiling equals net realizable value. Floor equals net realizable value minus normal profit margin. Sometimes you can't speak. Market equals replacement cost, but it cannot be above the ceiling or below the floor. In other words, if replacement cost is greater than ceiling, use ceiling. If replacement cost is less than floor, use floor. Otherwise, use replacement cost. Okay. Step 2, inventory item 1. Original cost, $210,000. Replacement cost, $250,000. Ceiling. Net realizable value is $240,000. Floor. Net realizable value less profit margin, $208,000. Okay. So let's change their names. The ceiling is net realizable value. The floor is net realizable value less profit margin. Alright, replacement cost is above the ceiling. So market equals ceiling equals $240,000. Now compare. Cost $210,000. Market is $240,000. $240,000. Lower equals 210. Inventory number 1, 210. Step 3, inventory item 2. Original cost, $400,000. Replacement cost, $370,000. Ceiling is $410. Net realizable value is $410,000, which is considered the ceiling because it's higher. Okay, 410. Net realizable value less profit margin is the floor, 405. Replacement cost is below floor. So what is replacement cost? Replacement cost is 370, so it's below the floor. Now compare. Cost is 400,000. Regional cost is 400,000. Market replacement market is 405. Market is 405. Lower is 400,000. Original cost is less than market. Inventory 2 is 400,000. Step 4, apply LCM to the total inventory. The question says uses the total of the inventory to apply the lower of cost or market. First, total cost, 210,000 plus 400,000 is 610,000. Now total market, 240,000 plus 405,000, 645,000. Compare the totals. Cost 610,000. Market 645,000. Lower is 610,000. Final answer, $610,000. Memory trick. Always solve these questions in 2 comparisons. Step 1, replacement cost. Adjust the market. Use ceiling and floor. Step 2, compare. Cost versus market. Choose the lower. Okay, so the floor is replacement cost. Find market. Compare cost versus market. Choose lower. This 2-step process works for every FAR question involving the lower of cost or market rule under US GAAP. Okay. So I really need to understand what's going on here. Okay. Let me go back to this question. It says the company reviewed its LIFO, last in, first out, inventory values for proper pricing at year end. The following summarizes 2 inventory items examined for the lower of cost or market. Here we have all the numbers. What amount should the company include in inventory at year end? If it uses the total of the inventory to apply the lower of cost or market. Okay. All right. It seems like I don't understand what's going on here in the question. I know the company reviewed its LIFO, last in, first out, inventory values for proper pricing at year end. So we can set the right price at the end of the year. Last in, first out. The following summarizes 2 inventory items examined for the lower of cost or market. We have all the numbers. What amount should the company include in inventory at year end? If it uses the total of inventory to apply the lower of cost or market. help me understand what's going on. I kind of get it, but help me understand what's going on so I understand the question. Step 1, imagine you own a store. Let's say you own an electronics store. You bought a television for $400. When you bought it, you recorded it. Or you recorded inventory equals $400. Now it's December 31st and you're preparing your financial statements. Okay? Your accountant asks, is that TV still worth $400? Is that TV still worth $400? That's what this question is asking. Step 2. Why would the value change? Many things can happen. Maybe a newer model came out. Customers don't want this model anymore. Competitors are selling it cheaper. You can only sell it for $370 now. The question is, should the balance sheet still say the TV is worth $400? Accounting says, no, don't overstate your assets. This is called conservatism. Step 3, that's where lower of cost or market comes from. Okay, lower of cost or market. Accounting says compare what you paid versus what it's worth today. Whichever is lower, that's the amount you report. Okay, notice something important. The company is not changing the selling price. It is changing the book value of inventory on the balance sheet. Step 4. So what is the market? Years ago, accountants realized that asking what is it worth isn't always easy. Instead, they estimated using replacement cost. They ask, if we had to buy this inventory today, what would it cost us? That's the replacement cost. But replacement cost can sometimes be unrealistic. So accounting puts limits on it. Step 5. Why the ceiling? Suppose you paid $210,000. Replacement cost is $260,000. But you can only sell it for $240,000. Would it make sense to say inventory is worth $260,000? No. You can't even sell it for that much. So accounting says maximum value is net realizable value. Okay? Maximum value is the net realizable value. That is the ceiling. Net realizable value is the ceiling. Okay. Net realizable value is the ceiling. That's how high you can go in price. That is the ceiling. Step 6, why the floor? Now imagine the opposite. Replacement cost falls to $150,000, but you know you'll sell it for $240,000. Your normal profit is $32,000. Then the inventory should not be valued below $240,000 minus $32,000, $208,000. Otherwise, you'd recognize a loss that has not really happened. That's why accountants created the floor. Step 7. So what is market? Market is simply replacement cost replacement cost unless it's above the ceiling. I see. Replacement cost unless it is above the ceiling or below the floor. Think of it like a hallway. Floor, ceiling. 208,000, 240,000. Replacement cost is allowed to move only inside this hallway. It is if it tries to go above 250,000, 240,000, bring it back down. I see. Yes, if it tries to go below 280,000, below 180,000, 208,000, bring it back up. That's all the ceiling and the floor are doing. Step 8, then comes the real comparison. After finding market, accounting asks only one question. Which is lower, cost or market? Choose the lower amount. Step 9, why does the question say uses the total inventory? This is the part many students miss. There are 3 ways to apply lower of cost or market. Item by item. Compare every inventory item separately. TV cost versus market, choose lower. Laptop cost versus market, choose lower. Phone cost versus market, choose lower. Second category, compare groups. Electronics, furniture, appliances. Total inventory. This question, pretend all inventory is one big pile. Total cost versus total market. Choose lower. That's why the question specifically says uses the total inventory. They are telling you which method to use. The entire story in one picture. You own inventory. Is it still worth what I paid? Find market using replacement cost, ceiling and floor. Compare. Compare cost versus market. Choose the lower. Report that amount on the balance sheet. The one idea to remember, this chapter is not really about formulas. It's about valuing inventory honestly. At year end, the accountant is asking if someone looked at our balance sheet today, would we be overstating the value of our inventory? The lower of cost or market rule exists to make sure. The answer is no. Once you see it as a valuation question rather than a math question, the formulas start to make sense. Okay, so let's go back to the question. The company reviewed its LIFO inventory values for proper pricing at year end. The following summarizes 2 inventories items examined for the lower of cost or market. The one that's lower, that's the one you take. So here, inventory item 1. Original cost is $210,000. This is what you paid for it. Replacement cost, $250,000. This is how much you would pay to replace or to buy the same inventory today. Net realizable value, $240,000. Net realizable value is, let me see what. Okay, let me do that. All right, now to understand everything, original cost is the cost that you paid for the inventory. Is the price that you paid for the inventory. Replacement cost is the cost if you would like to buy the same inventory today. That's what you would pay. Net realizable value. How could you state net realizable value? net realizable value less profit margin. So let's identify each one of them. All right, so original cost. The question is, what did we pay for this inventory when we bought it? This is the historical cost. Bought inventory, paid $400,000. Original cost is $400,000. This number never changes unless the inventory is written down. Replacement cost. The question is, if we wanted to buy this exact inventory today, what would it cost? Maybe prices went up. Last year, bought inventory for $400,000. Today, same inventory cost $430,000. Replacement cost is $430,000. Or price may have gone down. Today, same inventory cost $370,000. Replacement cost is $370,000. Replacement cost is simply the current purchase price. Net realizable value, NRV. This is probably the most important definition. Question: if we sold this inventory today, how much cash would we actually collect? This is the net realizable value. If we sold the inventory today, how much money would we collect? In other words, net realizable value, expected selling price. Expected selling price. Okay, cost to complete, cost to sell. Okay, net realizable value equals expected selling price minus cost to complete, cost to sell. Minus cost to sell, minus cost to complete, minus cost to sell. Think of it as the cash you expect to receive after getting the product ready and selling it. Example, you expect to sell the inventory for $500,000. It will cost $15,000 to finish it, so you subtract that. $5,000 to transport it. To transport and sell it, you subtract that too. Then selling price $500,000 less selling cost $20,000, or $480,000. So the inventory is expected to generate $480,000 in cash. All right. Net realizable value less normal profit margin, which is the floor. Now ask another question. How much of the net realizable value represents the inventory itself before earning our normal profit? Formula: floor equals net realizable value minus normal profit margin. Example, net realizable value $480,000. Normal profit for $40,000. $480,000 minus $40,000 is $440,000. The floor is $440,000. Why? Because accounting says we should not value inventory so low that we are recognizing a loss beyond what it is reasonable. Put all four together. Original cost, what did we pay? Replacement cost, what would it cost to buy today? Net realizable value is the ceiling. Okay, net realizable value is the ceiling. How much cash can we expect to receive if we sell it? Net realizable value, normal profit minus normal profit, which is the floor, minus normal profit less profit margin, okay, which is the floor. So what's the lowest reasonable value before cutting into our normal profit? All right. All right. So original cost, what did we pay? Replacement cost, what would it cost to buy it today? Net realizable value, how much cash will we receive when we sell it? That's the ceiling. Net realizable value minus profit or less profit margin is what is the lowest reasonable inventory value after allowing for our normal profit. Okay, so original cost, we have $210,000. Replacement cost, how much would it cost to buy it today, is $250,000. Net realizable value is $240,000, which is the ceiling. Net realizable value less profit margin is $208,000, which is the floor. So what do we do with these numbers now? All right, so putting everything together. Now we understand. We have the original cost, $210,000. Replacement cost, $250,000. Net realizable value, $240,000. Net realizable value less profit margin, $208,000. Now I want to find what amount should I include in inventory at year end. If I use the total, or let's say for inventory 1, if I use the inventory lower of cost or market inventory, how do I choose the right number here on inventory item 1? Okay, step 1, ignore the original cost. For a moment, pretend the original cost doesn't exist. Look only at these three numbers. Replacement cost, $250,000. Ceiling, $240,000. Floor, okay, net realizable value minus profit, $208,000. Your only question is, what is the market? The rule. Is replacement cost above the ceiling? Replacement cost is, yes, it is above the ceiling. Yes, so replacement cost is too high. Therefore, market equals ceiling. Net realizable value equals the ceiling, okay? Market is $240,000. At this point, you have completely ignored the original cost. Step 2. Now bring back the original cost. Now compare only two numbers. Original cost equals $210,000. Yes. Market $240,000. Ask, which one is lower? $210,000 is lower than $240,000. Therefore, inventory value is $210,000. I see. That's the amount you report for inventory item number 1. I see. Think of it as a 2-round boxing match. Round 1, find market. Okay, we need to find market price. Replacement cost compared to ceiling and floor. All right, replacement cost is $250,000. Let's compare to ceiling and floor. Ceiling is $240,000, floor is $280,000. Okay. Is replacement cost more than ceiling? Yes. So we use ceiling. Okay, we're not using replacement cost anymore. We use ceiling. Now we need to compare ceiling and original cost. Original cost is less than ceiling, so we use original cost, the one that's lower. I see. Okay. Replacement cost compared to ceiling and floor. Ceiling equals $240,000, floor $208,000 to $208,000, replacement $250,000. Too high. Market equals $240,000. We choose ceiling. Winner of round 1 is market. Round to lower of cost or market. Cost is $210,000. Market is $240,000. Choose the lower, 210. Final inventory is $210,000. I see. Step 1, replacement cost. Adjust to ceiling or floor. Okay, step 1, replacement cost. How much would it cost to replace this thing today? All right, so let's check our ceiling and our floor. You check your ceiling. Ceiling is lower than replacement cost, so we use ceiling. Now we need to compare ceiling and original cost. All right, so if ceiling is less than original cost, we use ceiling. But if original cost is lower, we use original cost. I think that makes sense. Okay. So for item 2, inventory item 2, original cost is $400,000. Replacement cost is $370,000. Net realizable value, which is the ceiling, is $410,000. Net realizable value less profit margin is for $405,000. The first thing we do is replacement cost. We compare replacement cost with ceiling and floor. So replacement cost is $370,000, right? $370,000. Ceiling is $410,000. Floor is $405,000. Ceiling is higher than replacement cost. Ceiling is higher than replacement cost. If ceiling is higher, let me see if I understand that. Ceiling and floor. If ceiling is higher, we choose what? We choose the replacement cost. So now we compare replacement cost and original cost. Replacement is lower than original cost. Okay. So item number 2. Original cost $400,000, replacement cost $370,000. Net realizable value ceiling $410,000, floor $405,000. Step 1, replacement cost. So replacement cost compared to floor and ceiling. Replacement cost is lower than ceiling and lower than floor. So should we use replacement cost in this case? Let's say we use replacement cost in this case. We compare replacement cost. All right, in this case, we choose replacement cost. We choose replacement cost. So now we compare replacement cost with original cost. Replacement is lower, so we use replacement cost. Is that right? All right, very close. Original cost $400,000, replacement cost $370,000, ceiling $410,000, floor $405,000. Find market. Ask yourself, is that replacement cost inside the hallway? Floor and ceiling. Floor is $405,000, ceiling is $410,000. Replacement cost is lower. I see. Okay. Replacement cost is lower than the floor. I see. So we're gonna use the floor. I see. Replacement cost is lower than the floor. So is $370,000 below the floor? Yes. Since it is below the floor, it is too low. So you do not use the replacement cost. Instead, you use market equals floor equals $405,000. Okay. This is the key correction. Step 2, compare cost versus market. Now compare original cost which is $400,000 and market, which is $405,000. Which is lower, Original cost is lower, so you use original cost. I see. Okay. I see. Okay, that makes sense. I see. So the ceiling and the floor is the correction line. Whatever is below the floor, you need to bring it back to the floor. Whatever is above the ceiling, you need to bring it back to the ceiling. Okay, that makes sense. That makes sense right now. This question was not a normal question. I think I want to come back to it soon so I can do it on my own. Okay. The company converted from the FIFO method for inventory valuation to LIFO method for financial statement and tax purposes. During the period of inflation, would the company's ending inventory and income tax payable using LIFO be higher or lower than FIFO? Ending inventory, income tax payable. Alright, let me do that instead. Don't need to be thinking about this. Time goes by so fast. This is one of the highest yield concept on a CPA exam. Don't memorize it. Understand the story. Okay. Step 1, what is the question asking? The company switched from FIFO to LIFO. During inflation, prices are increasing. The question asks, what happens to ending inventory, income tax payable? Step 2, understand FIFO versus LIFO. Imagine you buy the same product 3 times. January, 100 units at $10. June, 100 units at $12. December, 100 units at $15. Prices are going up. FIFO, first in, first out. FIFO assumes you sell the oldest inventory first. So you sell $10 inventory first. Your cost of goods sold is low. The inventory left $15 inventory. So ending inventory is high because it contains the newest, most expensive inventory. Yes. LIFO, last in, first out. LIFO assumes you sell the newest inventory first. So you sell $15 inventory first. Your cost of goods sold is high. The inventory left is $10 inventory. So ending inventory is low because it contains the oldest, cheapest inventory. Step 3, effective on income. Remember the income statement. Sales minus cost of goods sold equals gross profit. Right? Under LIFO, higher cost of goods sold means lower gross profit, which means lower net income. Step 4, effects on taxes. Taxes are based on taxable income. If net income is lower, lower income, lower taxes. So income tax payable is lower. Final answer. Item, ending inventory lower, income tax payable lower under LIFO during inflation. Last in, first out. Okay, the entire chain to memorize. Inflation, newest inventory cost more. LIFO sells newest inventory. Cost of goods sold increases. Gross profit decreases. Net income decreases. Income tax decreases. And for the balance sheet, LIFO, last in, first out. Old inventory remains. Old inventory is cheaper. Ending inventory decreases. CPA shortcut during inflation method. FIFO, cost of goods sold is low. LIFO, cost of goods sold is high. Yes. If you remember one sentence, make it this. During inflation, LIFO expenses the newest, most expensive inventory, yes. Inventory first, which increases cost of goods sold and decreases ending inventory, net income, and taxes. Okay, remember that? During inflation, LIFO, last in, first out, expenses the newest, most expensive inventory first, which increases cost of goods sold and decreases ending inventory, net income, and taxes. Okay. During inflation, if it's LIFO, last in, first out, cost of goods sold increases, ending inventory decreases, net income decreases, taxes decreases. Last in, first out. Ending inventory, income tax. Alright, let me read that again. The company converted from FIFO, first in, first out, method for inventory valuation to the LIFO, last in, first out, method for financial statement and tax purposes. Okay. During the period of inflation, costs are rising. Would the company's ending inventory and income tax payable using LIFO, last in, first out, be higher or lower than FIFO, first in, first out? If it's okay, so that you understand that if there is inflation, LIFO's cost of goods sold will always be higher. Okay? Ending inventory in LIFO will always be lower because you have sold the more expensive things first, last in, first out. So the more expensive things, you sold them first. So the items that are remaining, they are the cheapest one, or the first thing you bought at $10. So ending inventory is lower. Now that your cost of goods sold is higher, your income will be lower, your tax will be lower. That makes sense? Okay. If it was FIFO, first in, first out, you will be selling the cheapest items first. So your cost of goods sold would be lower, right? Because you sold the cheapest things first. Your cost of goods sold is lower. Your ending inventory would be higher. So your net income would be higher. Your taxes would be higher. Okay, makes sense. Let's keep going. We have 12 minutes left. The company commenced operations during the year as a large importer and exporter of seafood. The imports were all from one country overseas. The export sales were conducted as drop shipments and were merely transshipped at Seattle. The company reported the following data. Purchases during the year, 12 million. Shipping cost from overseas, 1.5 million. Shipping costs to export customers, $1 million. Inventory at year end, $3 million. What amount of shipping cost should be included in the company's year-end inventory valuation? Shipping costs. Shipping costs from overseas. 1.5 million. Shipping cost to export customers, $1 million. So what do you mean? It would be 2.5 million. I don't get it. The export sales were conducted as drop shipments and were merely transshipped at Seattle. The company reported the following data. So if you drop ship it, you still pay for shipping. No, or the company, or the client would pay for shipping. Shipping costs to export customers. I don't understand to export customers. Shipping costs to export customers. So customers pay for shipping. You would not report anything for shipping in this case. But let me see. Yeah, so the export sales were conducted as drop shipments. So drop shipping, customers pay for shipping. In this case, you pay nothing for shipping, but there is something shipment cost to export customers. To export customers. Which shipping costs become part of inventory? And which shipping costs become an expense? Let's tell the story first. The company buys seafood. The company buys seafood from another country. Before the seafood can be sold, it must be shipped to the company's warehouse. That shipping cost is called freighting, transportation in, shipping costs from overseas. Okay. This cost is necessarily to get the inventory ready for sale. Therefore, add it to inventory. Okay. Shipping costs to export customers. Shipping costs from overseas. Okay. So you add it. Shipping costs from overseas. Conducted as drop shipments. I don't get it. Okay. Step 2. The company sells the seafood now. The seafood has already become inventory. A customer buys it. The company ships it to the customer. The shipping cost is called delivery expense or freight out, shipping to customers. Shipping costs to export customers or shipping to customers. This is not part of inventory. It is selling expense. Shipping to you, inventory. Shipping to the customer, selling expense. Now apply it to the question. Purchases, 12 million. Shipping from overseas, 1.5 million. This is freighting. This is cost of shipping that you pay to get the inventory ready for sale. So it becomes part of inventory. Let me see something first before I spend so much time on this, because I see where you're going. Shipping expense. So the company purchased 12 million, but only has 300,000 left at year end. That means okay. That means only 25% of the purchased inventory remains. Only 25% of the shipping belongs in ending inventory. Okay, I see. Step 4, allocate the shipping. 1.5 million, 25% of that is 375,000. Okay, 375,000. I see. So the question asks what amount of shipping cost should be included in the company's year-end inventory valuation. So it's not inventory in total or in total inventory, but ending inventory. How much inventory do you have left? How much inventory you have left? You said that purchase, shipping cost, inventory at year end, 3 million. 3.3 million. Okay, inventory at year end is 3 million. Purchase during the year 12 million. You have 3 million left. Shipping cost from overseas 1.5 million. Okay. So what I need to know is shipping cost associated with 3 million. Three is 25% of 12. How did I find that number? 3 million divided by 12 million is 25%. Okay. So 3 million is 25% of 12 million. So 25% of 3 million is shipping cost. I see. Okay. That's the thought process. 4 minutes. The company has determined its December 31st inventory on a LIFO basis to be $400,000. Information pertaining to the inventory follows. The company has determined its December 31st inventory on a LIFO, last in, first out. Okay, LIFO is last in, first out, basis to be $400,000. What is $400,000? Inventory. Information pertaining to the inventory follows. Inventory information, estimated selling price, $408,000. Estimated cost of disposal, $20,000. Normal profit margin, $60,000. Current replacement cost, $390,000. At December 31st, what should be the amount of the company's inventory? Okay, so I believe it's the same ceiling and floor idea. Estimated selling price. So the original cost is $400,000. If you want to sell this right now, you would sell it for $408,000. Current replacement cost. If you want to buy this inventory right now, replacement cost is $390,000. This is replacement cost. Normal profit margin is $60,000. Which one is considered the ceiling and the floor? We have original cost. We have estimated selling price. We have current replacement cost. This is replacement cost, $390,000. So what is the first thing we do? We find the replacement cost. Replacement cost, is it, compare replacement cost with ceiling and floor. All right, what is the ceiling? Estimated selling price. Net realizable value is $408,000. What is net realizable value minus profit margin? Is 408,000 minus 60,000. 408,000 minus 60,000 is $348,000. 348. Wait. Replacement cost is $390,000. Replacement cost is $390,000. Ceiling is $408,000. Estimated selling price, net realizable value is the ceiling, $408,000. The floor is $348,000. The floor is lower than the replacement cost. So the floor is lower. Current replacement cost is higher. Oh wow, it's already break. All right, let's take a break. We'll come back to this.
Over net credit sales times 365. Day sales outstanding, average accounts receivable. Over net credit sales times 365. Day sales outstanding, average accounts receivable. Over net credit sales times 365. Day sales outstanding, ending accounts receivable. Over net credit sales times 365. Day sales outstanding, ending accounts receivable. Over net credit sales times 365. Day sales outstanding 365 over accounts receivable turnover. Day sales outstanding 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding 365 over inventory turnover. Days inventory outstanding 365 over inventory turnover. Days inventory outstanding 365 over inventory turnover. Times interest earned, EBIT over interest expense. Times interest earned, EBIT over interest expense. Times interest earned, EBIT over interest expense. Accounts receivable turnover, net credit sales over average accounts receivable. Accounts receivable turnover, net credit sales over average accounts receivable. Accounts receivable turnover, net credit sales over average accounts receivable. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt to equity ratio. Total liabilities over stockholders' equity. Debt to equity ratio. Total liabilities over stockholders' equity. Current ratio. Current assets over current liability. Current ratio. Current assets over current liabilities. Current ratio. Current assets over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Day sales outstanding. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Ending accounts receivable over net credit sales times 365. Day sales outstanding. Ending accounts receivable over net credit sales times 365. Day sales outstanding. 365 over accounts receivable turnover. Day sales outstanding. 365 over accounts receivable turnover. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt to equity ratio. Total liabilities over stockholders' equity. Debt to equity ratio.
We went over break
Liabilities
again today.
stockholders' equity.
Gonna have a warning, my friend.
Current assets over current.
Gonna get a warning for being late from break. All right, let's keep going. So let's go back to this question. Today we'll be doing 10 questions only on inventory so we can warm up. Wow, it's a long chapter. Okay, let's go back. Let's go back. The question was, at December 31st, what should be the amount of the company's inventory? Yes, we were talking about, let me read the question again. The company has determined its December 31st inventory on a LIFO basis. You know the LIFO is last in, first out basis, to be $400,000. Information pertaining to the inventory follows. Estimated selling price. Let me do this. Let me do that now. Okay. Okay, estimated selling price is $408,000. In fact, let me just go through this because I don't want to waste time. All right, what is the cost? That's step one. The problem tells you LIFO inventory cost $400,000. That's your original cost, okay? That's what we know. Step two, find the market. All right, you're given estimated selling price $408,000 less cost of disposal $20,000. Net realizable value is $388,000, which is the ceiling. So ceiling is $388,000 less cost of disposal. Okay, less cost of disposal. So ceiling is $388,000. To get the ceiling, you are given estimated selling price minus cost of disposal. You need to remove the cost of disposal. All right, understood. Ceiling is $388,000. Now find the floor. Net realizable value is $388,000 minus normal profit margin, $60,000. That will give you the floor, which is $328,000. Now compare the replacement cost with the ceiling and the floor. Replacement cost is $390,000, $390. Okay. Is the replacement cost above the ceiling? Yes, because the ceiling is $388. So we will be using the ceiling, which is $388. Now we will compare the ceiling and the original cost. The ceiling is $388, original cost is $400,000, so we use the ceiling, which is lower than the original cost. So ending inventory is $388,000. What I did not understand here was the disposal cost. The cost of disposal is $20,000. For you to find the ceiling, the net realizable value, you need to subtract the cost of disposal. Subtract cost of disposal from estimated selling price. If we did not have cost of disposal, estimated selling price would be the ceiling, $408,000. But since we have estimated cost of disposal, we need to subtract cost of disposal from estimated selling price so that we can have the ceiling, the net realizable value. The net realizable value. Okay. Net realizable value can be estimated selling price. We have the current replacement cost. All right, so that makes sense. 388. 388. Let's keep moving. The company completed its year-end physical count of inventory. The inventory was valued at first in, first out, which is FIFO, as you already know. FIFO cost and totaled $500,000. The company subsequently noted the following two items: 1,000 units of inventory with FIFO, cost of $10 each, were shipped and billed to a customer. FOB destination. These items were included in the physical count. 6,000 units at a FIFO cost of $5 each were held in consignment for one of its suppliers, but were excluded from the physical count. Okay, two things. What amount should the company report as inventory at year end? All right, so we have the starting point, which is $500,000. So we need to make some adjustments. The first adjustment is 1,000 units of inventory with a FIFO cost of $10 each were shipped and billed to a customer. FOB destination. These items were included in the physical count, but you don't tell me if the customer has already received them, if the customer has not received them, if they're still on the truck. I needed to know that information to know if I would count them, because FOB destination, if they have not reached the customer yet, you still own that inventory? Okay, there are two options here. We may count them, we may not. 6,000 units at a FIFO cost of $5 each were held on consignment for one of its suppliers. But were excluded from the physical count. Well, consignment from a supplier for one of his suppliers. It's not my inventory, it's the supplier's inventory. I would not count consignment. Whatever I hold on consignment, I'm not supposed to count it. Now this $1,000, let me count it. This 1,000 unit at $10. So that's $10,000 of inventory. If I remove that $10,000, I would have $490,000 of inventory at the end. If I don't count it, it would still be $500,000. So I am now battling between 500,000 and 490,000 because they didn't tell me a piece of information they are expecting me to know. If you say FOB destination, why do you give me that information? Why do you say FOB destination if you don't want me to use it? You just want to confuse me? Because if you tell me FOB destination, I need to know if it has reached the destination. If it has reached the destination, I need to remove it. It will be 490. If it has not reached the destination, I need to keep it, which will be the 500,000. So let's go. The question is testing one of the most important inventory principles on the CPA exam. Who owns the inventory on December 31st? Forget the physical count for a moment. A physical count can be wrong. All right. What matters is legal ownership. Yes. Start with the counted inventory. Physical count, $500,000. Now examine each item. Item 1, 1,000 units at $10 each were shipped and billed to a customer. FOB destination. Shipped and billed. These items were included in the physical count. First ask, what does FOB destination mean? Yeah. Ownership transfers when the customer receives the goods. So while the goods are still in transit, seller owns them. Okay? Since the company is the seller, the company still owns the inventory at year end. The physical count included these items. Were they supposed to be included? Yes. Value, $10,000. Since they were already included correctly, adjustment is 0. Okay, and we need to return back to this. 6,000 units at $5 each were held in consignment for one of the suppliers, but were excluded from the physical count. This is correct. You're not supposed to include them. This is the key phrase. Held on consignment for one of its suppliers. Who owns the consigned goods? The supplier. So I can't, yes, that's right. So the company is merely holding the goods for the supplier. Therefore, these goods do not belong to the company. Should they be included in the company's inventory? No. The physical count included them. All right. Excluded them. That's good. Was that correct? Yes. So value is $30,000, no adjustment. Okay. So it's $500,000. The answer is $500,000, but what I need to understand 1,000 units of inventory with FIFO cost of $10 each, shipped and billed to a customer. They were shipped. FOB destination. It was shipped. They didn't say if they received it, but it was shipped. So you in your mind, you know, it's still in the truck. They are still in transit. They're still in transit. That's what you got to have in mind. Shipped to the customer. What tricks me a little bit is the language where it says shipped and billed to a customer FOB destination. I'm asking myself, has the customer received the goods or not? So how do I resolve in my mind that they have not received the goods? That's an excellent observation. This is exactly where CPA exam tries to trick you. The phrase shipped and billed to a customer, FOB destination, makes you think, well, they shipped it. Maybe the customer has it already. But notice what the problem doesn't say. It does not say received by the customer, delivered to the customer. Customer accepted the goods. It only says shipped. Here is the rule that will save you on the CPA exam. With FOB destination, shipping does not matter. The only thing that matters is, has the customer received the goods? If the question does not tell you they were received, you assume they were still in transit. So your thought process should be FOB destination, ownership transferred upon delivery. Did the problem say delivered or received? No, seller still owns the inventory. Okay. Makes sense. Alright, they didn't say delivered. FOB destination. If it was FOB point of sale or whatever, ownership transferred. Alright, let me see. Compared to FOB shipping point. FOB shipping point. If the question says shipped FOB shipping point, then the moment you read shipped, you're done. It was shipped. The customer owns the thing. Okay, makes sense. This is what my problem was in this question, but now I understand the trick. We understand the trick. Let's go. The company adopted the dollar value LIFO inventory method on January 1st, year 2. In applying the LIFO method, the company uses internal price indexes. Internal price indexes in the multiple pools approach. The following data were available for inventory pool number 1 for the 2 years following the adoption of LIFO. At current year cost, at base year cost, internal price index, 1 year 2, $100,000, $100,000. I don't know what you're talking about here. All right, let's get some help. We're not gonna be wasting time with this if we don't know what they're talking about. Yes, talking. Talking about. Okay, this is where FAR starts to become more advanced. This is dollar value LIFO, and it's one of the more difficult inventory topics. The good news is that there is a repeatable process. Don't try to memorize the formula until you understand the story. First, what is dollar value LIFO? Imagine you own a warehouse. At the beginning of year 2, your inventory is $100,000. 1 year later, your inventory is worth $126,000. Now, ask yourself, did my inventory increase because I have more inventory or simply because prices went up? That's exactly what dollar value LIFO tries to answer. Step 1, separate quantity from inflation. Separate quantity from inflation. Suppose you had 100 apples times $1 is $100. Next year, 100 apples times $1.20. It's $120. Did you buy more apples? No. Prices just increased. Dollar value LIFO says, let's remove the effect of inflation first. That's why the problem gives you current year cost, base year cost, internal price index. The base year cost is the inventory with inflation removed. Okay? Got it. All right. The base year cost is the inventory with inflation removed. Look at the table. We have the date, January 1st, year 2. Current cost is $100,000. Base year cost is $100,000. Price index is 1. Okay. December 31st, year 2. 1 year later, 100 current cost is $126,000. Base year cost is $120,000. The price index is $1.05. Okay. December 31st, year 3. Current cost is $140,000. Base year cost $128,000. Okay. Price index is $1.10. All right, notice something. The company is telling you, we've already removed inflation for you. You don't have to calculate the base year cost. It is already provided. Step 2, find the new layer. Beginning inventory, base year dollars. 100,000.
What would you like to convert to?
100,000.
I found this on the
Hey,
web.
I ain't talking to you. I'm not talking to you. You think you're a human. I'm not talking to you. How do I turn you off? These devices thinks they are human. Step 2, find the new layer. Beginning inventory, base year dollars. Base year dollars, 100,000. End of year 2, 120,000. Increased. 120,000 minus 100,000, 20,000. All right, this creates a year 2 LIFO layer. Year 3, beginning layers, 120,000. and 128,000 increase. 128 minus 120 is 8,000. Okay, so 128,000 minus 120,000, 8,000. This creates a year 3 layer. Step 3, price each layer. This is the key idea. Each layer keeps the price index from the year it was created. Base layer, 100,000 times 1 equals 100,000. Year 2 layer, 20,000 times 105 times 1.05 is 21,000. Year 3 layer, 8,000 times 1.10 is 8,800. Step 4, add the layers. Base layer is 100,000. Year 2 layer, 21,000. Year 3 layer, 8,000. Ending inventory, 129,000. Answer 129. Okay. The entire dollar value LIFO process. Whenever you see one of these questions, follow these 4 steps. Step 1, use base year cost. Okay, use the base year cost. Base year cost is 100,000. Okay, 100,000. Step 2, find the increase. New layer. Okay, you find the increase from 100,000 to 120,000 at current year, cost at base year, cost internal price index. Current year, base year. Okay, so base year is 120. Find the increase, which is the new layer. Step 3, multiply each layer by that year's price index. Okay. Step 4, add all the layers. Why this works? Think of each layer's inventory increase as being stored in its own box. Base layer, $100,000. Price index is 1. So you multiply it by 1, it remains the same. Year 2 box, $20,000 because there is an increase. In base layer, there is an increase in base layer from 100,000 to 120,000. So the increase is 20,000. And the price index is 1.05. So you will multiply that 20,000 by 1.05. It will give you the 21,000. Year 3 box. There is a $8,000 increase. Year 3 box, the cost at base year is 128,000. But we are not coming from 100,000 now. We are coming from 120,000 because we have already counted the 20,000 from 100. So now the increase that we have from the previous year is $8,000 increase, and the price index is 1.10. So you will multiply the 8,000 by the 1.10. Each box keeps its own year's price index forever. That's the central concept behind dollar value LIFO. One final note, dollar value LIFO is tested much less frequently than regular FIFO LIFO freight in versus freight out, consignment, FOB, shipping terms, and lower of cost of our market. It's worth learning, but don't be discouraged if it feels harder. Many CPA candidates find this one of the more challenging inventory topics. Not really the way it has been explained here. It makes sense. I don't know if it will get a little harder, but here it does make sense to me. So the answer here is 129,000. 129. Because the increase over the years is 2029. Okay, makes sense. 129. Well, I have 129,800. Let me see what you got. Yes, 129,800. 120. Yes, that makes sense. That makes total sense. 129,800. Okay. All right. A company applying the lower of cost or market method reports its inventory at replacement cost. Which of the following is true? Original cost is lower than replacement cost. Net realizable value is greater than replacement cost. Yes or no? Here is the question again. A company applying the lower of cost or market method reports its inventory at replacement cost. If you report the inventory at replacement cost is lower. So original cost is lower than replacement cost. No. If original cost was lower, if replacement cost is lower, net realizable value is greater than replacement cost. Let's just understand that in our mind. We can do that in our mind. Original cost is $400,000. Replacement cost is $350,000. Let's use small numbers. Original cost is $4. Replacement cost is $3. Okay? Net realizable value is greater than replacement cost. Yes or no? If you report at replacement cost, net realizable value is the ceiling. The first thing, you find the replacement cost. Okay, what is replacement cost? $3. $3 is replacement cost. Now compare replacement cost between ceiling and floor. Let's say the floor is $2. The floor is $2. Replacement cost is $3. Ceiling is $4. Which one would you choose? Ceiling is $4. Replacement cost is $3. Floor is $2. So I would use $3 because $3 it cannot be lower than the floor, it cannot be higher than the ceiling, can be in the middle. So I use the $3, which is the replacement cost. That means replacement cost. Now I compare replacement cost with original cost. Original cost is $5. Replacement cost is lower than original cost. It has to be, if I'm reporting that replacement cost has to be lower than original cost? Yes. And replacement cost has to be lower than has to be lower than net realizable value. Yes, has to be lower than the ceiling. It has to be, yes. It has to be lower than the ceiling. Net realizable value is greater than replacement cost. Yes. I'm gonna take this. Now let's see if our reasoning was correct. But that shouldn't be hard, based on what we already know. Okay. What does it say? All right, the company reports inventory at replacement cost. That tells us something very important. Under lower of cost or market, you only report inventory at replacement cost if replacement cost is between the ceiling and the floor. That's right. Replacement cost is lower than the original cost. That's right. All right, let's prove it. Inventory is reported as replacement cost. That means inventory equals lower of cost, lower of original cost or market. Okay, if inventory equals replacement cost, then market equals replacement cost. Therefore, replacement cost is less than original cost. So the statement original cost is lower than replacement cost is false. What? Original cost is lower than replacement cost is lower. Yes, that's right. Replacement cost is lower than original cost. And that's what I meant. Okay, original cost is lower than replacement cost is false. It should actually be original cost is greater than replacement cost. That's correct, yes. All right, step 2. What about net realizable value? Ceiling. Remember your hallway. You have the ceiling, you have the replacement cost, and you have the floor. So ceiling, which is the net realizable value, is greater than replacement cost. That should be correct. That means replacement cost must be less than the ceiling. That's correct. Or written another way, net realizable value is greater than replacement cost. So the second statement is correct. So that, yeah, I mean, that's exactly what I was thinking about. But what confused me? Original cost is lower than replacement cost. Replacement cost is lower than the original cost. That's what I meant. And net realizable value is greater than replacement cost. That means replacement cost is in the middle. And that's right. Okay. Let's keep going. And that would be the last question. We still have 33 minutes left, but I have a lot more questions to do. The following information relates to the company's year-end inventory. The cost is $400,000. Estimated selling price $408,000. Estimated cost of disposal, the same question, $20,000. Normal profit margin, $60,000. Current replacement cost, $360,000. If the company uses FIFO to determine inventory cost, what is the company's year-end inventory balance? First in, first out. The company used FIFO, first in, first out. What is the cost? Cost $400,000. So this is not the ceiling and whatever. Let me see what the first question. Company applying lower of cost. Oh, lower of cost. Okay. This is called lower of cost. Following information is determine inventory cost. What is the company's? It's not lower of cost. This is not ceiling and floor. Use FIFO, determine inventory. What is the company's year-end inventory balance? Ending inventory. We need the ending inventory. We have cost, 400,000. Estimated selling price, 408,000. Estimated cost of disposal, $20,000. Normal profit margin, $60,000. Current replacement cost, $360,000. Now I need ending inventory balance. If it was lower of cost or market method, I would do the same thing, but it looks like it. Let me use that to see. Cost, original cost $400,000. Estimated selling price $408,000. But here is first in, first out. Let me do that so I don't waste time. Because I understand lower of cost. And I could do it. Lower of cost or market. But here we're talking about FIFO. First in, first out. Instead of wasting time, let's do this. Okay, so this is almost identical to the previous lower of cost market question. Let's solve it step by step. It's just okay. So you want okay, if that's the case, I can do it on my own. If that's the case, okay. Step by step. Original cost $400,000. Estimated selling price 408. Estimated cost of disposal 20,000. Normal profit margin 60,000. Okay. So here's what we do. Original cost 400,000. Estimated selling price. Estimated selling price is the ceiling. We need to subtract $20,000 out of 408. Subtract. It would be 388. Okay. 408 minus 20 is 388. So the ceiling is 388. Ceiling 388. Normal profit margin $60,000. Current replacement cost is $360,000. This is the replacement cost. 360. We have the ceiling. The ceiling is 388. Ceiling is 388. What is the floor? The floor is remove $60,000 from 388. Yes. So 388 minus 60. 328. The floor is 328. The ceiling is 388. The replacement is 360. Replacement is in between. So, wait. Replacement cost is 360. Floor is 328. Floor is 328. Lower than replacement. Yes. Ceiling is 388. Higher than replacement. Replacement is in the middle. Okay. You compare 360 to 400,000. 360 is lower, so we use the current replacement cost, 360. That being the case, that's what I'm gonna do. 360,000. And let's see. Nope. It's 388. What's going on? It's 388. What did I have wrong here? Lower of cost market, lower of cost, net realizable value, inventory. All right, so let me see what happened. Okay, so we have 388. Okay, net realizable value, estimated selling price minus cost of disposal, 388. Okay, we got that. That's the ceiling, 388. Step 3, calculate the floor. The floor, out of the 388, you subtract 60,000, 328. We got that. So floor is 328. Step 4, find market. Now compare the replacement cost to the ceiling and floor. Replacement cost is 360. Ceiling is 388. Floor is 328. Ask, is 360 above ceiling? No. Is 360 below floor? No. Therefore, market equals replacement cost. Market is 360. Okay? Because replacement cost is between the ceiling and the floor, it becomes the market value. Okay? Step 5, compare cost versus market. Cost is 400,000. Market is 360,000. Choose the lower, 360,000. Exactly. But why? The test says that it's 388. I would say that's what I said too. Well, the exam says that, or the question, the answer says the answer is 388. 388,000. What did we get wrong? What is wrong? See? Conservatism. If the company uses FIFO, when you solve it, you can accidentally use the lower of cost market rules, replacement cost, ceiling, and floor. However, under current US GAAP, FIFO average cost and specific and identification use lower of cost and net realizable value. LIFO and the retail inventory method use the older lower of cost or market rule with replacement cost, ceiling, and floor. Since this company uses FIFO, you ignore replacement cost. Ignore normal profit margin. Those numbers are distractions. You only calculate net realizable value. Step 1, cost. Cost is $400,000. Step 2, net realizable value is estimated selling price 408 minus 20,000, which is the disposal cost, 388. Net realizable value is 388,000. Step 3, compare. Cost 400,000, net realizable value 388,000. Choose the lower. Inventory 380. Okay. This is the rule to remember for the CPA exam. FIFO, average cost, specific identification, lower of cost, or net realizable value. Do not use replacement cost. LIFO, retail inventory method, lower of cost or market, where market equals replacement cost, limited by ceiling and floor. Okay. Ho 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 ho. In FIFO, you ignore replacement cost. That's a trick. In FIFO, ignore replacement cost. In FIFO, ignore replacement cost. LIFO, use replacement cost with ceiling and floor. FIFO, forget replacement cost. Compare cost versus net realizable value. First in, first out. FIFO, ignore replacement cost. Forget about it. Only compare original cost and net realizable value by subtracting disposal cost of disposal. Okay, from estimated selling price. I think we understand. This question will come back. This concludes our question number 10. In inventory. Inventory is not too bad. Think. Inventory not too hard. We can go quicker. Can move through inventory a lot quicker than that. Okay. All right, everybody. This was it for today. We did 10 questions today, and that was good. All right. We're attacking inventory. After inventory, we're gonna take property, plant, and equipment, and then we take investments. Investment is kinda longer, but let's not anticipate. Oof. Okay. Have a great day. Be productive. We did 2 hours anyway.
Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, 365 over accounts receivable turnover. Day sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, 365. interest earned. EBIT over interest expense times interest earned. EBIT over interest expense times interest earned. EBIT over interest expense. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt to equity ratio. Total liabilities over stockholders' equity. Debt to equity ratio. Total liabilities over stockholders' equity. Current ratio. Current assets over current liability. Current ratio. Current assets over current liabilities. Current ratio. Current assets over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Net profit margin. Net income over sales. Net profit